First, let's summarise what we learnt last time. Regardless of the impression they like to give, fund managers regularly produce less than the average market return. Buying and selling shares is little more than a gamble, and strong returns are often down to luck. It's harder than ever before for a manager to outperform the market consistently. Commercial pressure means fund managers sometimes advertise funds they wouldn't choose for themselves. And although there are good managers out there, picking the next star fund manager is almost impossible. It's now time to look at what it actually costs to invest. Like all businesses, fund managers have overheads. Running a fund management company isn't cheap, especially when the top managers earn around £2 million a year, including bonuses. And remember, it's you, the customer, who picks up the tab. How expensive is active fund management for the manager? In other words, what are they spending your money on?
Well, part of it is actually the costs of research and the costs of trading. The other major component, which is important in any retail fund, is marketing.
To me, most of these investment companies are just purely marketing companies. Let's set up a fund, let's see what we can sell, and it's never really about what's good for the investor, it's about what's good for the investment company.
Ultimately, fund managers need to make a profit. In fact, they're making around £10 billion from us every year, and that's regardless of whether or not they manage to produce a profit for us.
The job of a stockbroker is to transfer the wealth of the client to themselves. Typically, they extract in the range of 2 or 3% of their assets per year from the clients, and if you do that over a period of 20, 30, 40 years, eventually your broker winds up with more of your assets than you do.
We all get a return from the stock market in the long run. Now, let's say for the purpose of argument that that's an 8% return. But we in the markets get the net return after the insanely high costs of financial intermediation. And those can be as much as, say, 2% a year. Wall Street, if you will, in America, gets 70% of the return and puts up none of the capital and takes none of the risk. And we get 30% of the return, we investors as a group, there's no way around this, for putting up 100% of the capital and 100% of the risk. That is just crazy.
Part of the challenge is working out exactly what we are being charged. Investors typically use something called the annual total expense ratio, or TER, to compare the cost of investing in different funds. But the TER excludes dealing commission, stamp duty and other turnover costs that can add considerably to the expense of investing over time. So, in addition to those hidden charges, what else are we as investors having to pay? And more importantly, what impact do charges have on the value of our investments in the long term?
You might be looking at 1.5% per annum or more in management fees. It doesn't sound very much, but if you're talking about an investment strategy lasting over 20 years, it's a large amount of money that you're actually paying over to the fund manager. And you want to make sure that if you are doing that, you're getting what you're paying for.
Studies are being carried out, and the FSA is very active in this, on emphasising that one of the main determinants of longer run wealth destruction is the charges. Now, people tend to underestimate the effect of, say, a 1, 2 or 3% charge each year is a very substantial reduction in the wealth.
And the bad news doesn't stop there. Despite a marked increase in competition, management charges in the UK have been steadily rising over the last 10 years.
Charges are an insidious component of the investment proposition, and you know, for every pound that you pay out in charges is a pound that doesn't go into your pocket, which compounds over time. And what we've actually seen in recent research shows is that fees in the UK are actually going up rather than going down as they are in the States, and at an absolute level they're higher than they are in the States. And you know, I think there's a lot of talk about charges and fees and fee structures, the impact of fees. This is an argument that they've been having in the States for a long time, but it's only just really beginning to be held seriously in the UK.
There are some encouraging signs for consumers. The FSA's Retail Distribution Review will require fund managers to be fairer and more transparent when it comes to charges. In the meantime, investors should be on their guard.
I don't think the financial services industry cares really about just how much the general population despises and distrusts them. They have really not learnt the lessons that they should have learnt. I think it's endemic, actually, to the financial services industry that they lie, they dissimulate, they use smoke and mirrors to make us think that something's going to make us money when in fact it's going to make them money. We are very cynical, and frankly we are right to be cynical.
So, in summary, fund managers have large overheads, not least salaries and bonuses, and you pay the bill. Over time, charges that sound modest can seriously erode your savings. Many of the charges that consumers incur are hidden in the small print. And to add insult to injury, fund management charges have been rising year on year.